Okay, Adem, I unmuted you. Welcome to F.A.C.E.
Hi everyone, how you doing? And
Uh,
it's just Adam, so don't worry.
oh,
Just
is
spell
Adam?
it. Yeah, it's
Okay,
Turkish.
okay. So you Americanized it. How they say it in Turkey?
It's Adem.
Okay, see, so I'm from Skokie, Illinois, and see, I knew how to say it.
Yeah.
So
And I'm Greek, and I have a lot of Turkish friends actually.
Oh, no, that's very cool.
Yeah,
anyway,
I have a very good friend in New York actually, Omer.
yeah, and Steve was in the movie Midnight Express.
Oh, wow.
Remember that one?
No.
All right, well, you got to watch it. So Adem, I want to welcome you to our community. Thank you for getting up early. I've also often said, I've been on the West Coast for a long time. My life is like a farmer, up before sunrise,
Yeah,
asleep
for
after
sure.
sundown, except that I nurture seeds of greed for the harvest of commissions.
Yeah, no, I'm amazed
Anyway,
you get up at 4.
so I don't know if you've used Zoom before, buddy, but there's a green box on the
Saying share
drop-down
screen.
menu,
Hmm.
and that way you could share your screen.
Oh, got
I
it.
know
Okay.
you're mainly fundamentalist type analyst, but just want to see what you look at. And while we're doing this, Adam, why don't you tell us about your kind of your origins or beginnings in the financial markets and
Yeah,
how you got involved in it.
so pretty much so I just turned 28 recently, and I got into markets. Oh boy, senior year in high school. It was actually when 2008 happened, and I live in Scottsdale, Arizona, and
Oh, okay. Oh,
and it really, you know, rocked everything over here, like my high school and everything. I just remember everyone's parents and just going broke and bust suddenly, and a lot of houses like went on foreclosure. And I remember my dad like sweating bullets about it, and I never really like kind of understood why. But then when I kind of started reading about it in the news, I was kind of like surprised that so many people were kind of duped into, the house prices falling, like just because of like all the, like how they just thought they were going to go higher. And I just remember
right.
talking to my dad about it, and he was like, oh yeah, the house got appraised for like 800 grand, but it was like 450 grand like a couple years before. And I'm like, yeah, but we didn't like renovate or anything. Why is it so much higher? And he kept just saying like, oh, real estate always appreciates and everything. And so I don't know. I just kind of was like, when it kind of collapsed, I thought it made sense, but I guess, everybody else was kind of, upset about it and
Oh, yeah.
wiped out.
Well, some people, well, it's called the Great Recession, so I
Hmm.
don't know how great it was for many people, but okay, so it took, you're in high school, you're a senior, you're seeing us go into the Great Recession. So what do? You start reading books and anything influence you?
Yes.
Go
So
ahead.
I was in an economics class, but like high school, I don't know if it was, back when you guys went, but it's like a total joke. And like our teacher would just put on like movies and like pass out candy just to like keep us all like quiet. But I was actually
Sounds like
interested,
the Fed.
right? Yeah, more or less. And I was actually like interested in economics
Uh-huh.
and I thought economics tied into investing back then. And like I realized that was totally wrong. Like economics is all theory, but at the time I was like, oh, economics, that's about money. So I went to my economics teacher, and he didn't know anything. Like he was previously he was like I don't even know, he was like an English teacher before, just filling the role. So I was like,
Right.
all right. So I had a friend who TA'd for the calculus teacher, and I went in. I used to just ditch my class and just go hang out with him on his computer. And I started just like, I was a busboy, and I opened up a brokerage when I was 17, and it was 2008. And I just started buying like a bunch of like Krispy Kreme donuts, like all these like little pharmaceutical stocks that were like,
Uh-huh.
I just like speculative, that were trading for like less than $1. And the teacher saw me on like, the math teacher saw me on the browser, and he kind of was like, hey, come over here. And then on his screen he was trading options while he was teaching class. And yeah, and I was like, it just like blew my mind. And he was like, yeah, I do this. And he's like, I'm only a teacher. He's a chemist by trade, and he has like a master's or like a PhD in chemistry, but he was like, I just took this job because it's like, a government job, like stable income. And
Right.
good retirement. But
Free
he's like,
money from the taxpayer and they can trade at the
yeah,
same time. Sounds
pretty
good.
much. Yeah, and he would teach his class for like 20 minutes, and then the next 30, 40, he was just trading. And he was like, I remember he was like talking about Goldman Sachs. I'd like never even heard of that, and I was like amazed. So, yeah, I just got into. I
He
just
was
started coming in.
kind of a mentor for you.
Yeah, so he became a mentor. He made me sign like a paper that, like, God forbid if I lost money, he wasn't liable, and just he wanted to make it because I was a minor at the time, and so I ended up every day going into my economics class. I would just check in, and I would be like, yeah, I'm going to the bathroom, and I would just like leave. I would just go down the hall, and the teacher didn't even like notice or care. And I just went to this guy's class, and he taught me about like options and like trading and stuff, and yeah, and it was crazy. And
The
then
only high school teacher in history to have you sign a risk disclosure.
right, yeah,
That really
and
something. Yeah, it's a great story.
yeah, and he was like my best teacher that I never even like had, because I was never
Right.
his student. And so then yeah, I just graduated in in the summer, and then I'd taken a year off because I didn't want to really waste that much money going to college for economics. I was also kind of worried at the time because I thought, I mean, everything he did was like crazy high math, and I was never really that good at math, so I was kind of like, I was intimidated. But then I went to the junior college and I started just taking economics, and I remember my teacher telling me on like the first day, he's like, "Listen, I have kids who are straight A, smart, like scientists, going in for science, and they're taking this and they fail this class." He's like, because economics is a different type of thinking. He's like, you can't memorize things. It's like intuitive and it's analytical. And he's like, some people like think they can just memorize everything in school and get past it. He's like, this isn't that kind of class. So it kind of like interested me. I was like, oh, okay, cool. So I took it, and I just started like acing everything. And I started talking to him, and I was like, yeah, with economic stuff. And he was like telling me stuff about like, like, oh, there's gonna be like inflation and all these things. But I kind of was like disagreeing with him like on things. So I started Googling stuff myself, and I came across Peter Schiff. And I didn't really care for much of his stuff, but I liked how he was like taking on a lot of like the CNBC guys, and like how he just came out right. And
Yeah.
I got really interested in like the contrarian stuff. But then I kind of realized later, you can teach value investing, you can teach trading, but you can't teach somebody to be contrarian. It's kind of like you know what I mean? Like it's
Yeah,
kind
I
of
do
an
know what you mean.
emotional thing. Like some people, you'll tell them like, hey, when things drop, you want to buy more. But when the push comes to shove, they get scared and they pull out. So it's like kind of that speculative, going against the grain attitude. So that was the
Yeah.
first thing I
Okay.
noticed.
Interesting.
A lot of people like try, not faking. It's like they really try, but then like when a crisis happens, they freak out and they just go back to like what they think they should do. So that was like the first thing I kind of learned. And then, but yeah, long story short,
their emotion of fear overrides their intuition.
exactly.
Yeah.
And it just reminded me of like 2008. And yeah, and then long story short, so that money that I had with my teacher, and I bought like Krispy Kreme donut. I bought all these tiny stocks for like less than $1. I put like $5,000 in it, and then 2013 came. I didn't even touch it, and those stocks were going for like 20, $30 now because of the Fed's QE. And I remember I just like logged on to my brokerage, and I had like 70, 80K all of a sudden, like 4 years later from my $5,000 investment. And I knew it was just like, pure luck. Like it was nothing I did that made that money. So I kind of realized like, okay, now I have like a chunk of wealth. I need to like actually understand like fundamentals. So then I kind of just got into like reading Ben Graham, and I went into like commodities and all those things. And then I started a website, and then I ended up just dropping out of college because I realized like I'm not going to waste the money. And my father like passed away, so I had to like deal with that. And afterwards, I was just kind of I was like, I'm just gonna go out on my own. And yeah, and then just
What a great story.
Yeah, it was crazy. And then I got hired as an analyst for I was gonna go work for Sprott Global, and then I went to
Sprott.
Yeah, I went down there to San Diego, and then I never worked for them though, but I went there, got interviewed and everything, and thought it was really neat. But they went with someone else that was local, but I ended up actually going to Baltimore to work at Stansberry Research as an analyst because I knew a guy who was like, hey, you're a good writer. If you combine the two, that's like where the real interest is in like market people. You have really good analysts, but they can't write. They can't like explain it to people. And then you have people who are like good writers, but they don't understand anything about investing. He's like, if you can combine the two, you can have something special. So yeah, I went there, was an analyst, and I came back. I didn't really like living in Baltimore, so I just came back, and then I met the guys at Palisade Global, and they needed a macro analyst for everything. So they just hired me for 2 years, worked with them, and then they're about to take their gold fund, Palisade Gold Corp, public, and I just kind of wanted to go out on my own, and I started Speculators Anonymous, which is just my website now. And then I done that for a year. Then I just took it premium just for to just try to pay my rent and everything off it, and see some interest if I could get, because I'd beat in the market for a few years in a row, just luckily and thankfully. And yeah, and then that's just how I got to this point now.
Wow. I tell you that's you were driven, and at such a young age to be where you're at already. I could just tell you have a promising career ahead of you, and you've already proved it. I mean, you were hired by some people that they don't take anybody, Stansberry, etc. So when we talk about what you're seeing here on the register, on your radar, and dollar strength, and what markets you really pay attention to, and what you're thinking in here, Adam.
Yeah, so I've definitely thought that markets were really overvalued. I'm a big believer in Nassim Taleb's work, like black swans and anti-fragility. And anti-fragility, for those who don't know, means to gain from disorder, which I thought was a really interesting concept, because if things are fragile, they break. It doesn't matter, like imagine a vase. It's, even if you put the vase on a top shelf and the kids aren't running around it, it's still a fragile vase. So even if an earthquake happens or somebody bumps the shelf and you think it's safe, it'll still fall and shatter. So it doesn't change that the properties of the thing are fragile. So Nassim Taleb wrote this book called Anti-Fragility, or Anti-Fragile, sorry. And it's not really an investing book, but I thought it had a lot of great concepts in there for option trading, like optionality, that you just use a little bit of money, and you don't you can bleed yourself out losing premiums, but you'll never blow yourself up if you're just buying options. So right. I adopted that strategy, and I started kind of just placing small bets that I looked at were asymmetric. Hey, what's the risk here? Okay, worst comes to worst, I lose $1,000 over the year, so a little bit less than $100 a month buying these options. But if this market crashes, I can make 10, 20 to 1. So that's kind of how I just adopted it into my investment or speculative, philosophy. And
okay.
So I guess, yeah, so getting all that out of the way. So I'm also big on cycles, and I was realizing in 2018, I started looking at, the Fed was tightening, and I was big on the Austrian theory, with their business cycle. And I was like, okay, with Fed tightening, that's sucking money out of the, bank reserves. But at the same time, the U.S. Treasury is ramping up huge dollar deficits. And I'm like, well, it's creating a dollar shortage, because if the Fed's not adding money into the money supply and actually pulling it out, people don't, they don't think well, what's a dollar shortage? And the whole concept of a dollar shortage is, so if the Fed is sucking money out of this monetary system, that means banks have less reserves, primary banks who buy these
during
bonds.
QT.
Yeah, during QT. So the 2 years of tightening were leading to creating big fragility in the system. And I said one day, I was just writing about it, I didn't know when, but I said there's going to be something that breaks. And in September 2019, we saw the repo squeeze. Yeah, just blew out. And it really rocked markets. And I remember a month before I'd written that hey, because the Treasury came out and hey, we need to Trump had suspended the debt ceiling, or Congress, and they were borrowing a record amount of money. And I'm well, by them borrowing that money, all these banks don't have dollars. They don't have reserves from all the QT. Years of QTs suck their money dry. I have a chart actually on one of my articles I'll show you. And
okay, you're gonna have to share the screen again.
Oh, got it.
So go ahead, take it over and share the screen. I was just showing charts because you just had
sorry,
something up there. I wanted to,
It says you cannot start screen share while other participants.
Then I have to stop sharing. That's why. Let's see. Okay, how about now? Can you? I shouldn't have done what I did.
No, it's still the same thing.
Okay, so let me see. I should know how to do this. Okay. I'm gonna stop. I know what I have to do. Okay, let's see. Find you here. Okay. Okay. Try it now. I'm making you a co-host. Try it now.
Let's see. You will stop. Yeah. Okay. Okay. Great. Okay. Cool. Is my screen up? Can you guys see this?
Yeah.
Okay.
There
Cool.
you go.
So yeah. So on this chart, I thought it was really profound when I was doing my research. Is that so the GSIB and the FBO, these are pretty much international and U.S. banks, and as you can see, their excess reserve balances by banks. Right when the Fed began tightening in 2015, and when the actually the taper tantrums what really started it in 2014. Right. You see dollar reserves pretty much went from 1.4 trillion, 1.5. They got cut in half to January 2019, where they were just under 600 billion. So where did all those dollars go? Well, I don't have that one chart, but pretty much primary banks, they were loaded up with treasuries. So the repo market was really important to them because they had to keep buying. They can't tell the government no when they're trying to issue debt. So, well, I mean, I guess they can, but they don't. And they were loaded up with T-bills, but they're like, hey, we need dollars though. So that's why the repo market's so important, is that they can put those treasuries that they just buy from the Fed onto the repo market and get cash back, and just to keep doing it each night. Well, in September that broke because there was all sorts, just the perfect storm came together. The thing that people said like would never happen. The experts never see it coming, and then it happens. And corporations wanted their cash back for taxes or whatever. Everybody just needed cash at the same time, and the rate blew out. And then all of a sudden, the Fed began printing. They reversed the QE, which I pretty much put a chart here. Yeah. So all of a sudden, they're doing QT. It took them 2 years to cut it down. 700 billion, and then all of a sudden, within 2 months or 1 month when I'd written this, it already shot up pretty much 300 billion. Now it's at a record high. It's at almost 6. I think it's at 5 trillion now. So it's even higher than the QE era up until 2014.
Wow.
Yeah. So, and it's going to go way higher because the thing is the Fed's pushing rope at this point. So I guess, sorry, that was a lot of context to where we get to today. And so now, so the
Fed's pushing on a string right now. And, well, let's just think about this for a second, Adam. They were successful with their central planning from 2009 to, say, a month ago. With what they're doing now, isn't it possible that they could be successful in holding things together, not for 10 years like prior, but for a year or two?
Oh, yeah. Anything's possible, of course. And that is, I'm not saying the world's going to break or anything. That is still a very left tail, black swan event for the Fed to fail. That's not a likely outcome, but especially with the dollar strength, it's showing that even with all their printing, the world is still having huge demand for dollars. So there's going to be a wave of deflation happening. There's more demand for dollars than what the Fed can stop. Now I'm worried.
So is gold a short up here, Adam?
See, I like gold because even with all this dollar demand, gold's been rallying, and I think if you look at I have that one thing. Damn, I'd written about it a while ago. I don't have that chart on me.
That's okay. All right, so that's a true fact. Dollar has been in a pretty good uptrend, and gold at the same time, which a lot of people don't think that can happen because of the correlation. But so you think that what the Fed's doing Even if we had a real big squeeze on the dollar, which I don't think is going to happen right away, but could happen, I actually think that we're in a corrective phase there. But if that happens, won't people even liquidate precious metals? I mean, maybe even central banks,
Yeah, definitely.
China to defend the yuan
Oh yeah,
under this
absolutely.
pressure. Do you think there could be central banks selling? Because what's interesting is the premium of metals, physical metals now. What people have to pay, like $4 over spot for silver and 150, $200 over spot for gold. Um, doesn't that make you feel as a contrarian? So I'm just bringing out the contrarian nature in me, that if the public is willing to pay a 20-30% premium to own the physical, wouldn't you say the contrarian view would be, everyone's lining up to buy it, sell it to them?
Yeah, no, I definitely agree. Like, I'm personally not buying any more gold here. I haven't bought gold since 2014 when it was like 1,200 an ounce, and I've just held it. And I've bought some options on gold miners last year just because it was so cheap, and I thought the Fed was going to start easing sometime
Yeah.
in 2019. But I'm not buying any more gold at this point. Like, gold miners, maybe not right now, because I want the coronavirus. There's too many unknown unknowns right now.
Yeah,
But
closing up mines and yeah.
yeah, so I'd have to wait for, and not to mention with the VIX so high, option prices like generally around are high. So I'm just kind of
Yeah.
sitting and waiting. I made a pretty penny at the beginning of the year with some like long dated SPY puts and long the 10-year. I was long since like 2018, just holding. But like, yeah, gold could definitely go down.
Okay.
Like it could
That's an
definitely drop.
interesting conversation, going to bonds. So we had TLT blow off to 180, and during this emergency they went from 180 to 140, and they've rallied back a little bit more than 61.8. Is it possible that the bond market, since the Fed went to the commercial paper market and the junk market, that the most contrarian trade would be, I hear the most crowded trade on the board still is long
Long
bonds.
bonds.
What's your view? Are yields troughing out here as people are piling into bonds for safety?
So yeah, yeah, it's always a hard question because yeah, long bond has been a big, like, short
30
bond was really
years.
overcrowded in 2018, and I went
Yeah.
the opposite way when yields went hit 3%. I was like, well,
Okay.
and
Yeah.
also the yield curve started inverting in 2018, which I thought was interesting, which also bolstered the long bond theory. But right now, I personally wouldn't be buying bonds at this point because the yields, it doesn't make sense. But at this time in the cycle, but I don't think growth's going to really come back until because China's the marginal growth engine, and so China, I mean, America can like print all at once. It's not going to stimulate because it's not like it's added money unless they print and give everybody 10 trillion. A $1,200 payment to everybody isn't going to stimulate the economy. The loss of demand is far greater. Like, I think the stock market wiped out like 12 trillion, or now it's down to like 9 trillion off its highs. So
Yeah.
until they can re-stimulate greater than what's been lost, which they haven't done yet. I mean, they might. I think the Fed is getting ready to start monetizing the Treasury, but
Yeah, they've nationalized it.
yeah, and I think it's going to have to go much further because a $1,200 payment to people. I mean, I was reading like 1/3 of renters didn't even make their payment in March. So I mean, if this goes on for 2-3 more months, the Fed's going to have to do $1,200 a month, and that's a big toll. I mean, it cost them like what 1.2 trillion to do that stimulus with everything. So over the year, you're looking at an even greater dollar shortage then, because they have to get those dollars from somewhere else unless the Fed steps in and just says, hey, we're going to print in buyer bonds directly. And yeah, so the reason I said that the Fed's pushing growth here and why I'm only bullish the dollar is because there's just so much debt in the system that people need dollars to pay the soon we're going to get dollar disease, which is that term by Irving Fisher from the Great Depression, when people have to start liquidating assets, which could be gold, just to pay the interest on their dollar debt, or these other corporations. And
I have another book recommendation because I was influenced by something like this early in my career. called The Great Money Panic by Dr. Martin Weiss. I think it was written in the 70s or 80s when, you know, rates were spiking to 18.
Never
And
heard of that.
and he describes, and I'm wondering if you could see this too, where rates aren't going up because of growth, as you were talking about. They're going up because of the demand to roll over debt and not as much demand for the paper.
Yeah,
So
that's
your
what was
rates
that
could
called?
go up because of supply. The Great Money Panic by
Great
Dr. Martin Weiss.
Money Panic. Yeah, I'll have to check
Yeah,
that out.
so
That
you know, he
sounds
talks
interesting.
about in a liquidity crisis, rates going up to 20% and the dollar being good and everything else being bad. That kind of scenario sucks money off Mars.
Yeah, I mean, that's definitely a possibility. Like right now, everybody, we're all like in uncharted territory. Like you would think, because in 2008, right when the Fed started printing, the dollar dropped and like foreign currencies rallied. There was
Yeah,
like a big, you know, we only see those big money regimes like currency wars, like Jim Rickards talked about a couple times, like every
yeah,
generation. And it was like 1930s, 1970 or 45 with Bretton Woods, 71 with the gold breaking, 2011 or 2009 to 2011. And now we're at another point where are they going to have to do like a Plaza Accord where they have to like get together with foreign countries and cheapen their dollar? But if everybody's, you know, grasping for growth, you know, who wants to have a strong currency now? I mean, you see Trump all the time going out there saying like, hey, we want to cheapen our dollar, but it's not really
right.
up to him. I guess he
Who's
could.
it up to?
Well, that's the thing. I guess he would have to get everybody on board because even if he cheapens the dollar, you know, what could stop the other central banks from cheapening theirs? And it's
Yeah,
just a race to the bottom. And that's what
right.
Bernanke came out with in 2009. The theory, well, what if everybody cheapens at once? Which I don't think he understood like the relative market of traders because, you know, you can't have everybody trade, you know, it's subjective value. So everybody has, if one cheapens, you know, if everybody cheapened at once, nobody would be better off because it's like a beggar thy neighbor kind of prospect. Like if you cheapen artificially against country A, country B gets a spurt of growth. And I think that's why. So yeah, so post 2008, China's been the marginal growth engine. So if you look at the last three down cycles, like 2012, 2014, 15, and recently, it's up to China's demand because I was reading an IMF report and China post 2008 accounted for 49% of global GDP. So like wherever
Yeah,
China goes, the world goes. And in
yeah,
those last three cyclical slowdowns, China did big stimulus. They went on, they took a lot of debt and they eased a lot. And they started rallying, like, you know, the markets went with them because they started growing and they were like the train moving everybody.
right.
But China hasn't really been doing any stimulus, and I think it's because in 2016, I'm sure you guys know that when President Xi went out there and pretty much said, hey, you know, he wants to rein in the shadow banking industry and like kind of curtail the lending, so they haven't been as aggressive with their stimulus. And an indicator I like to use for you know, China as a leading indicator for their demand is the China M1 growth rate year over year. And if you look back at it historically, before each cyclical upturn, before each cyclical downturn, the M1 year over year growth rate crashed. And then their demand slowed, and then the global economy like reeled. And then when it started picking back up into the double digits, that showed that Chinese demand was coming back. There was a high turnover of cash. And but right now, at this point in the cycle, it's still very anemic. You know, it just hit 0% year over year last year. I mean, I'm sorry, January this year, and
Wow.
recently it just hit 4.8%. Now it just hit 5% in March, but that's still cyclically like really low. So it shows
Half
that
half of what it used to need to
exactly,
generate growth.
and that was always a leading indicator. And one thing that I like that I learned a lot from systems thinking is that there's big lag effects and like feedback loops,
Yeah.
like aggressive and then stabilizing. Aggressive real something like Soros came out with. Reflexivity is pretty much just feedback loops. And
So that's what we got in S&Ps with the aggressive Fed action was, um, you know, where you got this bounce, but what you were talking about, it may not last long term,
yeah,
right?
I personally don't think it's going to last long term. I think we still have more further down to go. And I do think that the dollar is going to drop a little bit in the short run, because I think, you know, a lot of people are jumping back in to the market thinking it's the bottom, and it could be. But I personally, there's a really good book by, I forgot his name, but it's called The Anatomy of a Bear Market, or The Anatomy of a Bear. By Russell Napier, a very like profound economist, and he went back and studied in 2011 all the great bear markets, the big four, and what he found was they were all led up to was with deflation. So what we're seeing right now in the world is a big wave of deflation, you know, with all this loss of demand. That's why I said the Fed's just pushing rope. It's just there's too much deflation. There's too much loss of demand. The supply chains are like China's recent export numbers were negative like 7%.
Yeah.
And you know, the US numbers were, you know, not that great either. And I'm assuming it'll get worse because there's like a lag effect. You know, it's going to get worse before it gets better here.
So cash is king, huh, Adam?
Yeah, I mean, I think cash is good here, but I mean, I wouldn't buy bonds. I mean, I do like gold, but it could have a big sell-off. You know, how I usually play things, I just like to do options. Like last year, I'd bet against the Australian dollar. I just bought 1 year puts on the F.A.C.E, Australian Dollar Trust, and or the British pound and everything. But right now, it's just everything's too like roughly priced. On the foreign currency market.
So let me ask you this: you've been in it for a while. Are you still uncomfortable doing nothing?
Well, actually,
I sense it in your voice a little bit, like, you know, there's nothing really out there compelling.
Actually, I've been really big on uranium for the last 6 months.
Oh, okay.
And uranium's actually just broke out to its 4-year high right now because the global. I don't know if you follow uranium. Like, I'm not a huge uranium trader. Like, I know a lot of them get crazy.
I'm a little bit more into kryptonite.
Oh yeah, like you know, it's
no, but I know what you're saying. Yeah.
Yeah. It's, you know, it's known as like the widowmaker trade, I think, because so many people get killed going every year. It's supposed to be uranium's breakout, but I actually am long uranium at this point just because the capital cycle there's been aggressive supply cuts. So finally, you're seeing like huge deficits in uranium, and like the world's biggest uranium mine, which was the Cigar Lake mine by Cameco in Canada, they just shut it off. Wow. And Kazakhstan is the largest exporter of uranium in the world, and they cut their output for the last 3 years in a row by 20%. So finally, you know, that put a floor on uranium price, and finally it's breaking out to a 4-year high. So I've been long Cameco options, but I've just held them for the last few months, and I still have many months to go on them. So I'm hoping, you know, it just keeps rallying. But so I've been long uranium, but other than that, like, you know, I really don't have many good ideas at this point, except, you know,
I think, you know, that's fine. You know, you know, on Twitter, what do people choke on, Adam, on Twitter? Saying I was wrong and I don't know. And to say I don't know is wisdom. You know, naturally it feels like, oh, I'm dumb, I don't know. But to realize it, and there's nothing there, is wisdom. What a great interview, Adam. I'm so glad I, you know, reached out to you on Twitter. And
yeah,
God, you know, you and I could talk for, you know, hours about what's going on. So let's do this again down the road and see how things are shaping up. And you know what, whether you like it or not, you're now Forex Stop Hunters trading warrior brother.
Oh, I appreciate it. You know, I really appreciate you reaching out and everything. And you know, thanks for having me. And yeah, you know, guys, I really appreciate it, and I like what you guys do.
Yeah, and if you you know, why don't I do this? Let me why don't you show your website before you go?
Oh yeah,
it's a nice looking site. So this is where you could find Adam, and his Twitter handle is @RadicalAdem.
Yeah, Adam with an E, ADEM.
Yeah.
A lot of people get that wrong. Yeah.
Adem, and your other homework assignment is to watch Midnight Express to see what you know, what freaked me out in my 20s when I saw that movie.
Awesome.
So anyway, are you showing your website?
Yeah. Oh, sorry.
Yeah, just share it.
Go to show
it. And
sorry.
That's okay. So you're still in Arizona?
Yeah, I'm still in Scottsdale.
Okay.
Yeah, it's starting to,
Yeah.
the car market's starting to really turn over here. So,
Okay, you know what? I want to ask you about this since your initial impression on everything came from a real estate collapse. There's been talk during this recovery here. I'm in California, in San Diego, and
mhm,
prices have taken out the '08 highs. Like a few years ago, we've already surpassed them.
mhm.
And they talk about housing shortage for the last few months because they haven't
Yeah,
built as many starter
yeah, yeah.
homes. But, you know, during '08, um, hedge funds bought up all these
Hmm.
single family homes. Do you think deflation can take its toll on real estate again to the same degree as it did in '08, '09?
Yeah, I mean, I definitely think it could. I don't think it's going to be as bad because going back to like the capital cycle, there was such a massive inflow of, home buildings in 2008 that did get bought up by hedge funds. So unless they start selling, but I think if the Fed is pretty much guaranteeing, like a hedge fund could just like, go to the Fed, or they could just, not directly go to them, but they can keep rolling over their debt or getting cash because now the Fed's pretty much insuring everything. I think
Yeah.
the Fed's really worried about that big wall of near junk debt, all that triple B debt that's like one notch away from being downgraded. There's like a record amount, like $4 trillion worth of triple B debt. I think that's what they're really worried about because once you have those go over, it'll suck the air out of the junk bond market, because a lot of hedge funds, they can't, and pension funds, they can't own. Yeah, sorry, hedge funds can. Pension funds and
Why
insurance
are
firms.
we bailing out hedge funds?
I just think the idea of them, it's that weird central bank idea of the wealth effect is that if you have one go under, that it'll just take away global demand. It'll cause a bank run. People will be like, well, what if that's my hedge fund, and they go and take their money out. So I think ever since
Yeah.
2008, the Fed's just trying to keep everything from teetering over. But then who bails the Fed out?
How do they fail? Do they
It's
not fail? Do
I
they
think
not?
that's just the people will one day just be like, hey, enough is it. But everyone thought negative rates would maybe be that, like, oh, negative rates never. But sure enough, rates look like they're going to go negative maybe, pretty soon.
Yeah.
They're already everywhere else. So I think until people or traders or investors finally stop, buying into it. But I think, it's like the dollar and the Fed, it's the prettiest mare in the slaughterhouse. Everywhere else looks so much worse that they're just, going, where's the least bad at this point?
Okay. Great interview, Adam. You have a bright career ahead of you. I'm glad we met. And thanks so much for your time today.
Oh, definitely. Thanks for having me.
I learned from you today. So
Oh,
thank
yeah.
you very,
Well, I
thanks
hope
for
to learn more
edifying
from
us.
you and everything.
Okay. Well, yeah. Okay. Learn this. Enjoy being young.
Yeah, no,
All
definitely.
right. Because, we all think money's the most important thing. You know what is? Time's your most important
No, yeah,
currency.
you're right. Definitely.
Well, how do you know that yet?
Oh, just when
All
my
right.
dad died, I was like,
Oh, that'll do it.
yeah, that was
Yeah.
definitely a big wake up. So,
Yeah.
also steeled my nerves a bit, but
Yeah.
no, definitely. But no, thank you for that. And thank you for having me, everyone. I really
All right. It
appreciate
was
it.
great, Adam. I'm really glad we met. So good luck to you. And let's set up a date for, sometime in the summer, June or something for you to come back and fill us in. Okay.
Yeah, absolutely.
All right. So that's going to be a wrap. Everyone has appreciated you. And I'm going to, I guess, say goodbye to everyone. And remember, this is what I say, Adam. Don't just count your pips, count your blessings. See everyone tomorrow. Good hunting the rest of the session.
Absolutely.
Adios.
Thanks, everyone. Bye.
Adios.